Okay, let's be honest, you're not imagining it. Your grocery bill is a little too high, the housing market feels completely out of reach, and it seems like every other headline is about layoffs. For most of us, the economy feels a bit shaky, and yet you flip on the news and here the stock market is smashing records high and hitting all-time highs. It's a bizarre and frustrating disconnect that makes you wonder, are we living in a totally different reality than Wall Street? It feels destabilizing, almost unfair, and you know what? You're right to be confused. In this video, I'm going to break down exactly why this is happening. I will demystify this strange new world, and by the end you'll have a much clearer picture of what's really going on behind the curtain. But before I get into all that, let's nail down the single most important concept you need to understand, the one most people get wrong. The stock market is not the economy, and the economy is not the stock market. The classic way to explain this is the man walking a dog analogy. Picture the economy as a man walking his dog down a path. He's moving forward at a relatively steady pace. He speeds up, he slows down, but his general direction is pretty predictable. Now picture the stock market as his dog, who's on a very long, very elastic leash. This dog is energetic, it sprints ahead, runs back, chases squirrels, and sometimes gets spooked and hides behind its owner. But over the long haul, the dog always ends up where the man is going. The man represents the real economy, things like GDP, jobs, and actual production. His path is the slow grinding reality of economic growth. The dog is the stock market, volatile and emotional, and always trying to guess where the man is headed next. Right now, it feels like that dog has sprinted a mile ahead, leaving its owner in the dust. Our job today is to figure out why. What has this dog so amped up while its owner seems to be slowing to a crawl? Well, there are four big reasons for this massive gap between Wall Street's party and the Main Street pain. The first major reason for the disconnect comes down to timing. Economic data and stuff you hear about on the news is almost always looking in the rear view mirror. The stock market, on the other hand, is obsessively, relentlessly forward-looking. Think about the numbers you see. GDP figures tells us how the economy did last quarter. The job report tells us who got hired or fired last month. Inflation numbers shows us where prices were in the recent past. They're all important, but it's like driving a car while only looking in the rear view mirror. It tells you where you've been, not where you're going. For instance, many reports show the US economy is facing a slowdown, though forecasts for 2025 have been revised slightly higher, with GDP growth now expected to be around 1.7% to 2.1%. The labor market, while not in a free fall, has shown signs of cooling, with unemployment ticking up to 4.3% in August before analysts projected it to hit 4.5% by the end of the quarter. For the average person, this data just confirms what they feel. Things are getting sluggish and the future is uncertain. But the stock market, well, it doesn't really care about last quarter's GDP. It's a giant collective betting machine constantly trying to price in what the world will look like 6 to 12 months from now. Every stock price is a reflection of what millions of investors think a company's profits will be in the future. So while today's economic data looks a bit wobbly, the market might be looking past it and seeing something else entirely. Maybe investors are betting that inflation will keep easing. Maybe they expect the Federal Reserve to cut interest rates, which makes money cheaper for companies and juices stock price. In fact, many analysts expect the Fed to continue cutting rates into 2026 to help stimulate the economy. And this creates the bizarre bad news is good news phenomenon. A weak jobs report can cause the market to rally because investors think, aha, Fed will have to step in and cut rates now. This forward-looking optimism, whether it's justified or not, creates a huge chasm between your present reality and the market's fantasy about the future. The market isn't reporting on the economy of today, it's placing bets on the economy of tomorrow, and right now those bets are incredibly optimistic. And this brings us to our second point, and it's a big one, because it gets right to the feeling of unfairness. We are living in a two-track economy. What does this all mean? Well, it means the economic reality for the top 10 to 20% of households is a world away from the reality for the bottom 80 to 90%. And here's the thing, the stock market almost exclusively reflects the health and mood of that top tier. Just consider this staggering statistic. The wealthiest 10% of Americans own about 87% of all stocks and mutual funds. The top 1% alone owns over half, meanwhile the bottom 50% of Americans own a mere 1% of the stock market. And this isn't just an opinion, it's just how wealth is distributed. So when we say the stock market is booming, what we're really saying is that the assets that's owned almost entirely by the wealthy are doing great. People in this top tier haven't been hit as hard by inflation, they have more disposable income, more secure jobs, and their spending continues to power the profits of the big corporations that dominate the market. They are the main customers of the latest tech, luxury goods, and travel, the very companies that are often the stars of the stock market. And meanwhile, the other 80 to 90% of the country lives in a different economic layer. gain. This is the Main Street economy, where the rising cost of groceries, gas and rent eats up a huge chunk of your paycheck. For this group, wages might not be keeping up with inflation, a layoff could be just around the corner, and the idea of investing is a distant dream when you're just trying to get to the next payday. This two-track system is exactly why you can see a headline about S&P 500 hitting new record right next to a story about the rising credit card debt and more people using food banks. The stock market is reflecting the financial success of one group, while the broader economic mood reflects the struggles of another. It's not a democratic poll of everyone's financial health, it's a barometer for where the capital is, and since capital is overwhelmingly at the top, the market acts as a scorecard for the wealthy, not the average citizen. And the third reason is a phenomenon that's become impossible to ignore. The market isn't one single thing. Its performance is being widely skewed by a tiny handful of superstar companies. You've definitely heard of them, the Magnificent Seven. This group, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta and Tesla, are so gigantic that their performance has an outsized pull on the entire market, especially big indexes like the S&P 500. I mean, at the end of 2024, these 7 stocks made up roughly a third of the S&P 500's total value. I mean, let that sink in. The S&P 500 is supposed to be a broad look at the 500 biggest US companies, but just 7 of them are doing most of the heavy lifting. In 2024, the Magnificent Seven soared, propelling the major indexes to double-digit gains. Even in 2025, after a mixed and volatile start of the year, their influence is undeniable. While their growth is expected to slow compared to previous years, they are still forecast to outpace the other 493 companies in the S&P 500. This creates a really misleading picture. The S&P 500 might be up for the year, but if you take out those 7 giants, the other 493 stocks, representing a huge part of the American economy, might be flat or even down. For long stretches, this is exactly what's happened. The market looked like it was roaring, but it was just a few generals charging ahead while most of the soldiers weren't advancing at all. The hype around artificial intelligence has been rocket fuel for this. Companies like Nvidia, which makes the chips that power AI, have seen their stocks go completely stratospheric. This AI enthusiasm has lifted Microsoft, Google and Meta too, as investors pour money into any company seen as a leader in this new tech. It created a feedback loop. Their stock prices go up, which makes the indexes go up, which attracts more headlines and more investment, and the cycle continues. So when you hear the market is hitting new highs, you have to ask which market? The broad market of hundreds of companies, or the concentrated market led by a few tech behemoths riding an AI wave? More often than not, it's the latter. The fourth and final piece of the puzzle is probably the most powerful force of all, the Federal Reserve, and a little acronym known as TINA, which stands for There Is No Alternative. I mean, let's start with the Fed. The Fed controls the nation's money supply, mostly through interest rates. When the Fed lowers rates, borrowing gets cheaper. This encourages businesses to invest and people to spend. But it has another huge side effect. It completely changes the game for investors. For decades, if you wanted a safe, decent return, you could put your money in bonds or even a saving account. But when the Fed slashes interest rates down towards zero, those safe returns evaporate. This is where TINA crashes the party. With interest rates so low, investors who need any kind of return on their money feel like they have no other choice but to pile into the stock market. There is no alternative. This isn't even about optimism, it's about a desperate search for yield. A flood of cash pours into stocks not because everyone is bullish, but because it's the only game in town. This massive inflow of cash, driven by Fed policy, pushes stock prices higher almost regardless of what's happening in the real economy. Even now, with the Fed signaling more rate cuts are likely in late 2025 due to a softening economy, this dynamic is in full swing. The market is basically betting that if things get worse, the Fed will just turn on the money spigot again, creating a safety net for the stock prices. And this all ties back to our two-track economy. Who has the most capital to invest? The wealthy. Low rate punished savers, so the wealthy are forced to move their vast pools of capital into stocks to preserve and grow their wealth, which further inflates the market. This brings us to a pretty alarming metric, the Buffett indicator. Popularized by Warren Buffett, it compares the total value of the stock market to the country's GDP. As of October 2025, the Buffett indicator is screaming significantly overvalued, sitting at a historically high levels of over 220%. This is a direct reflection of the TINA effect. Market valuations have become totally detached from the real economy that's supposed to support them. The dog isn't just on a long leash anymore, it's been fed a diet of pure caffeine by the Federal Reserve and is running wild. Understanding this isn't about predicting a crash or giving you financial advice, it's about empowering you with knowledge. It explains the nagging feeling of frustration frustration when the world you see on the news doesn't match the world you actually live in. The system isn't rigged in some grand conspiracy, but it is structured in a way that allows the stock market and the real economy to live on two different planets. The man and his dog can be very, very far apart for a very long time. And if this explanation helped clear things up and you want to better understand the forces shaping your economy, make sure to hit that subscribe button and ring the bell so you don't miss my next video. I'm really curious, what's the biggest disconnect you're seeing between the market and your own life? Let me know in the comments below, and I'll see you guys in the next video.